Hi, this is George Sandman. I'm the founder and CEO of Growth Drive. Growth Drive is the #1 best-selling business advising platform, and this is our podcast, The Business Advisor Hot Seat. Now, in the hot seat, you're going to hear from industry leaders, thought leaders, your colleagues who are going to share tips, techniques, war stories about building a thriving advisory business based on delivering client wins. We're going to get into it. We'll get into it about the Growth Drive methodology, the Clarity software, what we see out in the world, so much more than just the system. And I'm also the author of The Growth Driving Advisor, which is based on over a decade of being an advisor to advisor, working with you and your colleagues, helping them build their practices, helping them through client engagements, and it's really proven strategies for leading businesses from stuck to best in class. Check it out. So strap in. We're going to light this up. Here we go.
Well, hello, everyone, and welcome. We're going to do something a little different this week. And what I'm going to do is I'm going to read and comment very briefly, if I can, keep it brief, about a white paper that we are working on. We're busy workshopping. We have a pre-final version that we're busy workshopping with a lot of you, your colleagues, with you potentially. And so I'm going to read it, make a couple of comments, and I would welcome your feedback. So here we go. It is June 3rd, 2026. This is following up a year almost to the day from the first white paper we dropped about strategic capacity as fundamental to business value creation. The new white paper has some evolved thinking. It's called The Asset Class Standard: How Strategic Capacity Quantification Improves Private Capital Market Efficiency. And I co-wrote this with Andy Weevil of 10X Growth. And when you get a copy of the paper, his contact information and creds are there. And Andy first brought me this idea and wrote the first draft, in fact, and we took it and ran. And so let me tell you what we have. I'm going to just start reading. And if you hear the shuffling of papers, it's because I've gone analog and I've actually printed this thing out. So start at the top. Executive briefing. This paper is written for the ecosystem of capital market professionals who shape private middle market transactions, buy-side and sell-side investment banks, M&A advisors, exit planners, fractional CFOs, profit and value growth advisors, growth drivers, private equity and strategic buyers, and the lenders whose returns depend on the same underlying capability the equity markets price. The market addressed in this paper: private businesses with $2.5 to $100 million in annual revenue, which represent 30 to 35% of U.S. GDP. And by the way, more than 50% of new jobs. The problem: 70 to 90% of acquisitions, depending on the source, right? 70 to 90% of acquisitions fail to meet the acquirer's investment goals, often accompanied by significant post-close integration friction. The definition of success: an efficient market in which sellers realize fair value, buyers achieve the required return, integration completes on schedule with minimal friction. The root cause of the problem: structural inefficiency in the pre-LOI information environment. Buyers commit to targets evaluated on financial narrative on the SIM without independent evidence of operational capability. Sellers control business data and transaction narrative. Sound familiar? By the way, I've shared this paper with a number of professionals, and the feedback has been the concept's universally positive. We're talking here about investment bankers. We're talking about growth drivers. We're referring to people who play in the private equity space. All very positive on the concept. Nobody said you're off on the argument. Some stylistic comments about how the paper is laid out, but universally positive feedback so far. But I'll read on, and feel free to berate me if I miss something. All right. So we've covered the root cause. Now there's a shift underway. Private capital forces reward businesses that can predictably and sustainably grow free cash flow post-transaction, right? Makes sense. Private capital markets reward businesses that can predictably and sustainably grow free cash flow post-transaction. The discipline to measure that capability before commitment now exists. The solution: independent quantification of strategic capacity, the operational capability that determines whether projected performance survives the transaction, but applied pre-LOI and available to both sides in the transaction. So both sides of the table are going to be speaking the same language, and could be speaking the same language, relying on very similar data, similar financials, similar understanding of operational capability, and negotiating from there. Imagine. The standard. Here's the standard. Asset class businesses, those with a strategic capacity score above 85, deliver structurally repeatable performance, independently transferable value, and the operational and data quality the market is pricing. These businesses command premium M&A pricing. I mean, the data's in. Okay, executive summary. Between 70% and 90% of acquisitions in the 2.5 million to 100 million private middle market fail to achieve their intended objectives. Footnote 1, which is a Harvard Business Review article from 2020, don't make this common M&A mistake. Patel, drawing on more than 300 practitioner interviews, identifies structural failures within the M&A process itself rather than post-close execution alone as the primary cause. It's an important footnote. You should read Patel's article, Patel's book, frankly. It's really good stuff. The cause is structural. Capital is committed against financial narratives, SIMS, confidential information memoranda, SIMS, EBITDA multiples, earnings before income tax, depreciation, and amortization, EBITDA multiples, growth projections without independent evidence of the operational capability that determines whether those narratives hold under new ownership. Footnote 2, SBA Office of Advocacy. Okay, there's some great data in there, U.S. Chamber of Commerce. A defined population of private businesses already operates at the institutional standard sophisticated capital rewards. Sandman 2025 calls this the asset class. Companies with strategic capacity scores of 85 or above, where performance runs on documented systems and proven non-founder leadership, value is independently transferable, and operations and data are themselves the asset the market is buying. Listen, and operations and data are themselves the asset the market is pricing. Asset class businesses command premium M&A pricing, attract ideal fit acquirers, and unlock the full range of private capital monetization options, platform acquisitions, annuity stream distributions, and strategic buyer premiums. Strategic capacity is the measurable construct that defines this standard. It is the primary driver of transferable equity value in private capital markets, per Sandman and Weevil in 2025. That's the last year's white paper. Okay. Transferable equity value in private capital markets, quantified across 24 growth-driving objectives, organized into 3 dimensions of growth: predictable profits and cash flow, predictable sustainable growth, and predictable transferable value. Operational maturity exists on a continuum, and strategic capacity measures position on it directly. The asset class marks the point at which it reaches institutional standards. Applied to pre-LOI target evaluation, the methodology produces 4 compounding improvements to what we have today. 1, it identifies the highest probability return targets. Asset class businesses, measured, not asserted, represent the highest confidence acquisitions for buyers seeking predictable post-close performance without structural transformation costs. 2, it gives buyers independent operational intelligence pre-LOI. A quantified strategic capacity score, a modeled transferable equity value calculation, and an actionable readiness roadmap produced in hours not days, weeks, or months, produced in hours, convert target evaluation from narrative judgment, qualitative, into evidence-based qualification, which is quantitative. Okay, we're moving from qualitative to quantitative. We are quants. 3, it equips sellers to present defensible operational quality. Sellers who demonstrate high strategic capacity with evidence command higher valuations from the buyers best suited to value what they have built. I'm going to dig in on that a little bit. It equips sellers to present defensible operational quality. So if you're presenting a company to the market, investment bankers, growth drivers, CPAs, if you're presenting a business to the market, imagine having evidence that this business can predictably and sustainably grow free cash flow independent of the current shareholders. Imagine. 4. Nope, I'm sorry. 3. It equips sellers to present defensible operational quality. Sellers who demonstrate high strategic capacity with evidence command higher valuations from the buyers best suited to value what they have built. 4. It improves outcomes across all 3 private capital return models: equity value at exit, annuity distributions, and lending, because the determinant of success in each is the same. Can this business deliver predictable and sustainable growth under new ownership or capital structure? The systematic effect is informational symmetry, a market in which buyers, sellers, and their advisors operate from shared, quantified evidence of operational reality. The result is higher returns on closed deals, better structured transactions, more accurately priced debt, and a measurable improvement in the success rate of private capital deployment. For advisory firms, strategic capacity quantification is not a marginal improvement over traditional target evaluation. It is the standard around which the next generation of private capital advisory will be organized. And we see that happening in the market today, right? But ad hoc, unstructured. Okay, now let's move into the paper itself.
Introduction. Private capital markets exist to deploy capital into businesses that can generate predictable returns through equity value growth at exit, annuity generation from distributions, or interest on lending. Across all 3 models, the determinant of success is the same. The underlying business must deliver the performance the investment thesis assumes under new ownership, independent of individual heroics. That capability is strategic capacity. Defined by Sandman 2023 and established as the primary driver of transferable equity value by Sandman and Weevil 2025, strategic capacity is a business's measurable ability to predictably and sustainably grow profits, cash flows, and transferable equity value through proven non-founder leadership, documented systems, scalable processes, and disciplined financial management. It is quantified across 24 growth-driving objectives organized equally into the 3 dimensions of business growth: predictable profits and cash flow, conceptually equivalent to free cash flow, predictable sustainable growth, and predictable transferable value, and expressed as a strategic capacity score benchmarked against best-in-class performance. The asset class is the subset of private businesses operating at institutional standards, scores of 85 or above. Where performance is structurally repeatable, value is independently transferable, and operations and data quality are themselves the asset the market is pricing. The problem is not that the asset class businesses are rare in absolute terms. The problem is that the market has lacked the tools to identify them systematically and to distinguish them at evaluation from businesses presenting similar financial metrics that lack the underlying capability to deliver projected performance post-transaction. The metrics on which target evaluation has historically relied, EBITDA multiples, revenue growth, market position, describe what a business has achieved. They do not answer the question that determines whether the transaction will deliver. Will this business continue to perform and grow per the investment thesis after the transaction closes? The consequences are well documented. Many failures are not dramatic. They are quiet erosions of value.
returns that look compelling on a model but never materialized, integration plans built on assumptions that did not survive operational contact, debt structured against cash flow the business could not sustain. The conventional explanation points to integration challenges. The more rigorous diagnosis, confirmed by Patel 2025, identifies the root cause as structural, embedded in an M&A process architecture that systematically suppresses the independent operational intelligence both sides require. This paper applies strategic capacity quantification to that structural gap. Quantification converts operational reality from contested narrative into shared evidence, equipping buyers to identify asset class targets with confidence, equipping sellers to demonstrate institutional quality with evidence, and equipping the advisors on both sides to build SIMs, investment theses, and deal structures grounded in demonstrated capability. The market context reinforces the urgency. The most capable acquirers are professionalizing M&A into a repeatable operating capability, building proactive deal theses, embedding absorptive capacity assessment into pre-deal gates, and stress testing execution plans in live transactional environments. Yet, over 80% of corporate deal flow remains externally introduced per Deloitte in 2024. Meaning the majority of targets still reach buyers through sell-side advisors and intermediaries. The advisor who can demonstrate a target's strategic capacity objectively against the criteria evolved buyers already apply holds a decisive advantage over those presenting financial narrative alone. The structural problem in M&A target evaluation. The 70 to 90% acquisition failure rate is not a failure of effort, intelligence, or capital. The buyers committing resources, the advisors structuring transactions, and the sellers presenting their business are sophisticated professionals operating in good faith. The failure rate persists because the M&A process was designed for a market that no longer exists, one in which sellers held the informational high ground, financial performance was the primary indicator of asset quality, and operational capability could reasonably be inferred from the numbers. Sophisticated capital now demands evidence of operational capability that financial statements cannot supply, and the most disciplined acquirers have built internal frameworks to demand it. The process architecture through which targets reach those acquirers has not kept pace. The result is a structural asymmetry that suppresses the independent operational intelligence both sides need. The sell-side process suppresses operational intelligence. The traditional process, from SIM creation through pre-LOI engagement, produces three consequences for the buyer's information environment. And I refer you again to Patel's work on this. First, the evaluation framework is set before the buyer arrives. The SIM frames the opportunity, the investment thesis is shaped by it, and the timeline is established on the sell side. Second, competitive cadence accelerates the process at precisely the point where genuine operational evaluation would be most valuable, converting speed from a tool of efficiency into a signal of commitment. Third, the data room is constructed to support the seller's thesis rather than to reveal operational reality, leaving founder dependency, undocumented processes, leadership gaps, customer concentration, and culture risks outside the explicit indicators the buyer can evaluate before commitment. We're talking pre-LOI, right? These impacts operate together. The buyer enters a process they did not design, accelerates through it under competitive pressure, and evaluates on information curated to a thesis they inherited rather than constructed. The space for independent operational discovery contracts at exactly the moment it is most needed. Footnote 4. And I refer there to Patel K. 2025, Buyer-Led M&A, the Framework, which documents these dynamics across more than 300 practitioner interviews. Right, the data's in. The buy-side reaction locks in conviction. Three dynamics compound across the pre-LOI period and explain why sophisticated buyers proceed despite information they recognize is insufficient. The buyer adapts to the sell-side narrative rather than constructing an independent thesis. Integration considerations, the operational realities that determine whether the deal will deliver, are deferred to post-close rather than treated as deal-shaping disciplines. And as the financial model accumulates evidence supporting the inherited thesis, conviction compounds, even though financial models do not surface the operational conflicts, system incompatibilities, and absorptive capacity constraints that determine post-close return. By the time these dynamics resolve, the buyer is committed to a narrative shaped externally and validated insufficiently. The deal proceeds. The failure rates that follow are predictable. You see why we talk about inefficiency of the private capital markets. A market that has a failure rate this high is not efficient. Okay, but I digress. All right, next section, the compound effect. The sell side, so let's consider those last two sections and they compound together. The sell side process suppresses operational intelligence. Buy side reaction locks in conviction without it. Together, they explain not only why acquisitions fail at the rates they do, but why those failure rates have persisted despite decades of sophistication, increased sophistication in financial diligence, deal structuring, and integration management. The financial discipline of M&A has advanced. The operational discipline required to match it has not, until now. What the market has lacked is the systematic solution, independent quantification of strategic capacity applied pre-LOI, available to both sides, grounded in evidence rather than narrative. And we need only think about the evolution of quality of earnings and the emergence of sell-side Q of E to see that there's a solution and that the market will rise up to meet it. Next section, strategic capacity as the screening standard. Strategic capacity is quantified through a strategic capacity score from 0 to 100, benchmarked against best-in-class performance across 24 growth-driving objectives, organized equally into the three dimensions of business growth. Dimension 1, predictable profits and cash flow, or predictable FCF. Dimension 2, predictable sustainable growth. And Dimension 3, predictable transferable value. And I've written elsewhere about why we divide these into the three dimensions, but it does certainly help adding an intuitiveness to the analysis. Okay. Applied to pre-LOI target evaluation, the score, again from 0 to 100, addresses precisely what the structural mechanisms above suppress. Independent, quantified assessment of whether a business can deliver predictable results as an asset under new ownership, independent of any one leader. And we have a score band continuum here in the white paper, and I'll read down them. The scores go from 0 to 40, 41 to 54, 55 to 69, 70 to 84, and 85 plus. And they are in turn founder state, and that's where there's high founder dependency. Growth creates friction, and value is non-transferable. The core focus is generally in these businesses on building growth capacity through dimensions 1 and 2. Growth capacity for the uninitiated is dimensions 1 and 2 weighted for growth for dimension 2. Predictable, sustainable growth. Okay. The next band, 41 to 54, these are emerging state. Some systems are in place, but execution is inconsistent. Profit is unpredictable. Value is compressed and likely inaccessible. Core focus remains on growth capacity. Side note of the billions and billions and billions of dollars of businesses that are in our system to date. The average is 54.1. Okay, so if you understand that the average of operational
excellence, if you will. Comparison to best in class is 54, right? As a failing grade when I was in school, is a 54. These are businesses that are profitable, that are growing, but they lack the systems. The average business have 54. Once you understand that and you think about the failure rates of M&A, you can start drawing a line, a storyline between the two, right? Okay. Next is maturing businesses with scores from 55 to 69. These are maturing businesses that have a solid foundation. Growth is possible, but capacity constraints limit transferable value and threaten M&A success. They're weighted towards growth capacity. But the high end of this range at 69 begins building dimension 3. And again, I've talked elsewhere about how these are gears inside the business engine, and they compound, right? Now we get into a more interesting class of business from an investment perspective, the professional state. This is scores 70 to 84. These businesses demonstrate strong execution. They have predictable profits and growth. They're approaching institutional quality operations, and value is increasingly transferable in toto, right? As is the likelihood of M&A success. 85 plus defines the asset class. We don't say 85 to 100 because there are no perfect businesses out there. And as businesses grow at 85, they continue to grow FCF, they continue to create sustainable growth, adapt to market conditions, et cetera. But as they do, they break things. So it is theoretically possible to have 100, but we've never seen a business with a score of 100. 85 is the asset class. This is the institutional standard. These businesses operate independent of any one leader. They deliver predictable, sustainable growth through documented systems proven out by data. They command premium M&A pricing. They unlock the full range of private capital monetization options, platform acquisition, annuity stream distributions, and strategic buyer premiums. And what's annuity stream distributions need not be to a lender nor to an acquirer. Those can be to the shareholders, the current shareholders of the business. We're talking about prosperity, wealth, and value creation, asset class. And below the chart, we have a comment. The score is the shared reference point informational symmetry requires, a single, transparent measure of operational reality that buyers, sellers, and their advisors can engage on equivalent terms. It is we begin to speak the same language. We blow the smoke out of the deal. Transparency, deal transparency. Imagine. The asset class. Operational substance behind the score. Now let's get into some detail. What follows is the operational substance behind the score. Evaluated against each of the three dimensions. What follows is the operational substance behind the score evaluated against each of the three dimensions. I'm going to go through the three dimensions in turn. Dimension 1, predictable profits and cash flow, establishes operational foundations. An asset class business does not merely report strong EBITDA. It generates that performance through senior leadership running the business without founder involvement, a workforce with documented roles and measurable accountability, a high percentage of codified recurring revenue, margins at or above the industry norms, accurate standards-compliant financial reporting, and a scalable sales process that converts pipeline without founder participation. Standard operating procedures, or SOPs, for on-time, on-spec delivery are documented, universal, and enforced. Customer satisfaction is measured, managed, and structurally embedded in retention. Free cash flow is growing at or above market rate, and the systems producing it are transferable. That's a dimension 1 business that's very strong in dimension 1. Let's turn to dimension 2, predictable, sustainable growth. Dimension 2, predictable, sustainable growth, confirms the business can expand, not merely maintain. At 85 plus growth, growth is not further founder-driven ambition. It is the output of a clearly articulated strategic plan with leadership alignment and execution discipline, a curated culture of accountability and continuous improvement, scalable hiring and development systems, and disciplined budgeting and forecasting that translate growth goals into measurable financial commitments. The market opportunity is demonstrably large and accessible. Products and services are differentiated and defensible. Marketing generates demand repeatedly. Innovation is embedded and ongoing. An asset class business does not grow because its owner works harder. It grows because its systems are built to grow. Dimension 3, predictable transferable value. I'll make a comment here. If you think about what we just described for Dimension 1 to Dimension 2, would you not want to work for, own, be associated with that business? Go back and listen to what I just described. Now, that does not mean the business is M&A ready. There are other things that the market has not forced the founder or the senior leadership team to confront, typically. Well, we see the average business comes into the system with a Dimension 3, with a capacity score of 42. Dimension 3, predictable transferable value, is where institutional quality is confirmed. A business can be profitable and growth capable and still fail to transfer because value is locked in relationships, informal knowledge, undocumented processes, or legal exposures that surface only under buyer scrutiny post-LOI. At 85 plus, none of that is true. The business presents a clear, aligned narrative supported by audit-ready financials. IP is owned, documented, and protected. Contracts are enforceable. Market position is strong with high growth relative to peers, a diversified customer base, defensible barriers to displacement, and a recognized brands that contributes independently to trust, retention, and pricing power. An asset class business does not just perform well, it presents well to the most rigorous buyers under the most demanding diligence. They have it together and they can prove it. Most private businesses do not qualify into the asset class, not because their financial performance is weak, but because performance exists on a spectrum of operational maturity that ranges from ad hoc effort and founder dependency to defined processes, documented workflows, and data-driven decision-making embedded across the organization. The degree to which a business operates through structured systems independent of any one leader determines the predictability and sustainability of its free cash flow growth, and therefore the transferable value private capital can price with confidence. Right? What happens after an LOI? The price starts getting whittled down based on risk. An asset class business presents as a very low risk, high confidence asset. For buyers, asset class businesses are the highest confidence acquisition targets. For sellers, designation commands premium pricing and unlocks the full range of monetization options. For lenders, asset class status materially reduces the company-specific risk component in credit decisions, supporting more favorable terms and larger facilities. Now I'm going to stop here. The paper goes on to go into specifics about three-dimensional target screening. Each dimension consists of 8 growth-driving objectives and addresses a fundamental question sophisticated buyers and the sellers preparing to meet their scrutiny ask during target evaluation. Dimension 1 surfaces the operational reality behind the financial narrative. Dimension 2 grounds the growth thesis in scalable infrastructure. And Dimension 3 establishes the deal readiness financial models alone cannot validate. Following an objective and key result OKR methodology, footnote 5, the OKR methodology was developed by Andy Grove at Intel in the 70s, and C. Grove A, 1983, High Output Management, and popularized by John Doerr at Google in 1999. See Doerr, John in 2018, Measure What Matters. Sandman adapted the framework to strategic capacity measurement in the Growth Driving Advisor 2023. Now I'm going to skip reading through
the 3 dimensions. Okay. I'm going to move over and to point out that there's a 25th question, the 25th objective, which is time to market. In a bear market, you better have high strategic capacity, right? There's a flight to quality, and an asset class business presents as a high quality business. In a bull market, strategic capacity can be lower to achieve the same price and deal close success rate. And I discussed this with my good friend Bob Dunn, formerly of GF Data, now Chief Product Officer at ACG, the Association for Corporate Growth, and we geeked out about this and what we see in pricing in up markets and down markets. And a fascinating conversation. We did a podcast on it a while ago. So I'm off script here. Okay. I'm going to just talk about the principal transaction models, and then we'll wrap this up. How's that sounding? Okay. Strategic capacity across the principal transaction models, because capital is hydraulic. Capital finds a way. Capital has different risk tolerances and different mechanics for generating a return. Okay. And we're going to look at equity and debt. Strategic capacity quantification adds the same analytic. And by the way, same is true for commercial insurance, right? Business insurance. Think about it. Lenders and insurers have the same, have many of the same metrics by which they look, or many of the same lenses through which they look at a business. Okay. Strategic capacity across the principal transaction models. Strategic capacity quantification adds the same analytical layer to every private capital transaction, independent, evidence-based assessment of whether the underlying business can deliver what the investment thesis assumes. What that layer reveals and what it is worth to each side depends on the transaction model. And we go through several. Pure investment, build transferable value, and exit. Founder builds, sells into private equity, buys, builds, sells, etc. We're all familiar with that model. 2, platform. Demonstrated capacity absorbing tuck-ins, right? That's another way of looking at this in the market. Tuck-in, for the tuck-in business, understanding the strategic capacity at a granular level of the tuck-in company and its developing capacity, right? That is very powerful. And then debt, pricing cash flow durability. I mean, at the end of the day, we are all pricing cash flow durability, aren't we? So the common thread across all 4 models, the methodology serves the same purpose. It converts operational reality from contested narrative into shared quantified evidence. Buyers gain independent intelligence calibrated to their transaction model. Lenders gain operational evidence of cash flow durability. Sellers gain the means to demonstrate quality with quantified support, and advisors gain the analytical discipline that distinguishes them from transactional intermediaries. The systemic effect is one this paper has argued throughout. A market in which every transaction, strategic, financial, or debt, is structured around shared operational evidence is one in which capital is priced accurately, deals are structured more durably, and the success rate of private capital deployment improves measurably. And we go into a discussion of how to create a strategic capacity score. And it won't surprise you that is using our software, the Clarity software, and its companion, Claire AI. And we talk about why manual operational intelligence fails on its own terms, strategic capacity and quality of earnings. That's where I'm going to go next. Strategic capacity analysis and quality of earnings, complementary layers. Listen up. A second objection is that buy-side quality of earnings analysis already addresses operational risk. It does not. And the distinction matters. Q of E, quality of earnings, Q of E validates the financial record, testing whether reported earnings are real, sustainable, and properly normalized.
Strategic capacity analysis validates the operational and human infrastructure that produces those earnings, testing whether the business can continue to deliver and grow under new ownership. The two are complementary layers operating on different aspects of the same business, mutually reinforcing rather than redundant. A target can pass Q of E cleanly and still fail strategic capacity screening. The founder-dependent business with $2.4 million of EBITDA and an undocumented customer handover is the canonical example. Conversely, a target with high strategic capacity but unresolved Q of E issues is not yet investable. Each surfaces what the other cannot. Consistent with Q of E precedent, market practice would warrant the accuracy and completeness of the operational and financial data underpinning the analysis, while conclusions, which involve judgment, qualitative judgment, forward-looking assumptions, and integration considerations, remain the buyer's responsibility addressed through diligence, structuring, and targeted indemnities. Now, in the next section, we talk about the Clarity platform and how efficient it is to use. And let's talk about the three outputs of that system. Three primary outputs. I'm on page 16, as it's currently laid out. A strategic capacity score. So the three outputs. First, strategic capacity score of 0 to 100 is a quantified benchmark against best-in-class performance, a quantified benchmark against best-in-class performance across all three dimensions and each dimension individually. This replaces intuition with data and documented evidence, enabling data-driven qualification before LOI commitment. The score identifies the strategic capacity gap, the distance between current state and the level required for transaction success. 2, transferable equity value calculation. This is a modeled valuation, calculation of value, based on current strategic capacity and normalized EBITDA, expressed through three reference numbers grounded in market comparable data. I'm going to make a comment here. Anyone sitting with a client and using discounted cash flow calculation of value to price the value of their business as an asset is not meeting the high standard to which we hope they would hold themselves. And I'm just being nice. I'll leave it there. I'm incredibly passionate on this point. Pick up the phone, call an investment banker, ask them how they price deals. And DCF is definitely in the file, but it is not the determinant calculation of value. I'm very passionate on this point. Okay. Transferable equity value calculation, a modeled valuation based on current strategic capacity and normalized EBITDA, expressed through three reference numbers grounded in market comparable data. Market comp data. 1, gross enterprise value. That's revenues or EBITDA multiplied by the top multiple for financial transactions. We've got to be conservative. Financial transactions in the subject sector. It is impossible to predict strategic value. Okay? Gross enterprise value. The next, transferable value, the post-due diligence M&A price after we've accounted for risk, calculating net of company-specific risk that strategic capacity quantifies. And then, of course, between those, we have the value gap. And that's the difference between the two. Value currently inaccessible to the seller and a primary source of post-close return for the buyer. Again, imagine the consequences of having that information. These calculations inform offer strategy and integration planning on the buy side, and pricing strategy, expectation setting, and gap closure programs on the sell side, equipping both sides to negotiate from quantified evidence rather than positional assertion. And third is an actionable readiness roadmap. Excuse me. A prioritized summary of improvement areas aligned with the subject's strategic context. For qualified targets, it informs integration planning and post-acquisition value creation, use of funds, shorthand. For targets that do not yet meet a given screening threshold, it becomes the foundation for systematic capability development. Then on page 17, we go through an illustrative example, an illustrative application. And now I'm just going to move into the impact on the private capital markets. Impact on the private capital markets. Strategic capacity quantification does not add a step to the M&A process. It shifts the costliest step, months of committed advisory and buyer resources expended on targets that were never going to deliver, into hours of quantified evidence delivered before commitment. The most direct evidence of impact comes from the foundational work itself. Sandman and Weevil in 2025, drawing on clarity assessment data, modeled a 2x to 3x increase in transferable value to buyers and a 3x to 10x increase in acquisition offers for businesses that systematically develop high strategic capacity across all three dimensions. These describe a category of value creation accessible to businesses that reach the asset class threshold, and a category of acquisition return accessible to buyers who screen for it. Risk mitigation. Systematic analysis identifies founder dependency, operational weaknesses, leadership gaps, and integration complexity before significant resource commitment, surfacing precisely the risks the structural sell-side mechanisms obscure. On the buy side, this converts pre-LOI evaluation from inference to evidence, allowing buyers to walk away from targets that will not deliver, structure deals around the risks that remain, and commit confidently to targets that meet the standard. On the sell side, the same analysis identifies risks before they emerge in diligence, giving sellers the opportunity to address gaps, reset expectations, or restructure strategy before late-stage discovery costs are incurred. Because selling a business is not inexpensive either, right? For lenders, the same risk surfacing function operates against credit decisions, converting the company-specific risk component of credit pricing from inferred adjustment to an evidence-based one, supporting more accurate spread, covenant, and facility size decisions across the credit spectrum. Resource efficiency. Months of wasted due diligence are eliminated by focusing evaluation resources exclusively on targets with quantified transferable capability. The savings to advisory firms, both direct diligence costs and the opportunity costs of deals that should never have been pursued, are substantial. For sellers, the symmetric efficiency is equal. A quantified score and roadmap structure preparation time around the gaps that actually matter to buyers, rather than assumptions sellers and their advisors infer about buyer concerns. Portfolio returns. Screening for systematic capability rather than financial metrics alone directly improves the quality of closing deals. Because strategic capacity is the primary driver of transferable equity value, businesses with the highest scores are those most likely to deliver predictable post-close performance. The relationship is structural, and pre-LOI screening is where it becomes actionable. A buyer who screens for asset class capability acquires the businesses most likely to deliver the thesis. A seller who develops asset class capability commands the valuation the underlying quality warrants. A lender who prices credit against strategic capacity evidence funds the businesses most likely to service obligations through cycles. And there's been a marked rise in defaults on private capital loan instruments. But marked rise, okay? Deal velocity for qualified targets. Firms that screen more rigorously close faster on the deals they pursue. When transferable capability is quantified before commitment, pre-LOI, resources are deployed with confidence rather than distributed across a bloated pipeline of uncertain quality. And we all know the failure rate of deals trying to go to market. It's substantial. The sell-side equivalent operates with equal force. Sellers entering the market with quantified evidence shorten buyer evaluation cycles, reduce diligence-driven friction that erodes evaluation and timelines, and qualify themselves to buyers most prepared to transact at the standard the sellers has built. There is going to be capital for Strategic capacity, 62 businesses. Okay, this is simply going to be sold at a lower price to earnings ratio, at a lower multiple. Deal velocity is not the absence of discipline. It is the product of discipline preparation on both sides. Imagine if deals went to market and they closed rapidly, not because there was a panic that one might lose the deal for a variety of reasons, right? How often does the seller just walk away from the table? Probably for strategic capacity reasons. So what if we build velocity because we have enough evidence to say, yes, this is a shoe-in, credit, Dune, approved, let's roll. The systemic effect. The four mechanisms compound. Risk is mitigated earlier. Resources flow to the right activity. Returns improve on the deals that close. Velocity accelerates for targets that warrant it. Deals that should close at fair valuations, equitable valuations, on credible timeliness, with both parties operating from the same evidence base. Capital is priced more accurately. Transactions are structured more durably. The success rate of private capital deployment improves measurably across strategic, financial, and lending markets alike. We then go on from methodology to practice and talk about the fact that the adoption barrier is compressed from months to hours. So the adoption barrier for analyzing strategic capacity pre-LOI is challenging. Once one has a very time-efficient mechanism for scoring strategic capacity, with the understanding that it will be done bona fide, right? Things change, and we offer those tools readily. By the way, you can buy my book and build your own system, $29.99, SRP on Amazon. Or we should talk. So I'm going to read the conclusion. Let's wrap it up. Conclusion. Strategic capacity quantification represents the necessary evolution of private capital target evaluation, from financial assessment to systematic capability measurement, from narrative-dependent judgment to evidence-based decision, from the structural asymmetry that has produced decades of suboptimal outcomes to the informational symmetry that produces measurably better ones. The framework is established. Strategic capacity is the primary driver of transferable equity value in the private capital markets, measured across the 24 growth-driving objectives of the three dimensions, expressed through a score that positions every business on the operational maturity continuum from founder state through asset class. The methodology is operationalized. Clarity converts the framework into pre-LOI intelligence at the speed, depth, and consistency contemporary transactions require. The application is dual-sided. It benefits both sides of the table. Buyers gain independent operational intelligence before commitment. Sellers gain the evidence to demonstrate institutional quality. Lenders gain operational grounding for credit decisions. Advisors on both sides gain the analytical discipline that distinguishes strategic partnership from transaction intermediation. The most capable acquirers are professionalizing M&A into a repeatable operating capability. True. The most disciplined lenders are pricing credit against operational evidence rather than financial inference. True. Sellers and their advisors face the mirror, a market in which the buyers and lenders that matter most expect quantified evidence, and they will reward those who provide it and penalize those who do not. The asset class standard exists. The methodology to identify it, to develop it, and to price it accurately is proven. The infrastructure to deliver it at transaction speed is built. The question for M&A, private equity, lending, and capital market professionals is not whether the industry will adopt systematic strategic capacity quantification, but rather whether their firm will lead that adoption. And the adoption is happening, ladies and gentlemen. We then cite references: Deloitte, Dorr, Grove, Harvard Business Review, Patel, Everett, the Exit Planning Institute, GF Data, McKinsey, A lot of research went into this. I have bios for the two authors. Grab a copy, sit down, crunch on this, and you do not have to be an M&A professional to have this concept power your advisor business. Wealth advisors, listen up. Who better than you? Who better than you to talk with your clients about whether or not their business, which we have as an asset on their wealth plan, is in fact an asset class business? Whether the 25 million they state it is worth has any diligence around it, any reality. Is that transferable value? Is that a chimera? Is that number too high, too low? Who better than you to pick up the phone and call your client and say, hey, maybe we should talk about your business as an asset and invest just a little time, a little diligence in sorting out whether this business is the asset it needs to be. I hope you'll pick up the phone. You can call me, call your clients, get a copy of the paper, make it your own. And so with that, I'll say thank you very much. Please let me know your thoughts, your feedback. What did we hit? What did we miss? I really look forward to hearing from you. I'm easy to get hold of, george@growth-drive.com, growth-drive.com. And my last name is Sandman, Sandman. I'm therefore very Googleable. So look me up, give me a call. We're here. We are committed to the success of the private capital markets and committed, therefore, to helping you. Thank you. Have a great day.